Hey, this is Justin with DayTradeTheMarkets.com on last day of January here in 2013, and I wanted to break down the gold market today because there were just some beautiful setups. But along those lines, before I talk about that, I want to talk about more of a broad issue that I think a lot of traders struggle with. I know that I battled this big time for the first 5 years or so of my career, and especially a lot of new traders tend to struggle with this, and that's kind of the idea, two levels. Number one, quantity versus quality, and also kind of how we define our job as traders. So the reason I wanted to show gold is because there were so many good setups, but a lot of times we focus on the E-mini S&P, or that's kind of the first market that we look at. We look at a lot of markets, but the last few days it's been a conflicting messages in the E-mini S&P. Things haven't been lining up beautifully, and if you saw the video I did yesterday, I talked about some of those conflict type situations, but it was a type of scenario where things were not lining up perfectly. Okay, and so what I think can happen, especially to a lot of new traders, is, well, we're taught in our society that when you are going to make money, you go to work and you need to be doing something. And in trading, a lot of times what can happen is you can force things. You can start seeing things and start talking yourself into less optimum type situations just because you think, well, I've got to do something. I'm in front of my computer. My goal is to make money. What do I need? I need to find a trade. And so what happens is that leads to less than optimal decisions. That leads to losing trades. That leads to trying to get that money back. That leads to over trading. That leads to paying your broker more than you're paying yourself. And I think what's really important, and along those lines, sometimes I hear people say, well, how many trades do you get a day? And I think that's kind of a faulty question. The question's not how many trades that you're going to take. That's quantity. That's needing action or excitement. The question is quality. It doesn't matter if you take one trade a week if it's a great trade versus 10 trades a day if they're great trades. It's really not important how many, it's the quality. And it's kind of like the idea of, well, I heard a quote, I'll paraphrase, but a Warren Buffett quote where he says, I don't go around looking for 7-foot high bars to jump over. I go looking for 1-foot bars that I can step over. It's the same idea, like a crocodile laying in the weeds. They don't go chasing everything they see. They wait until something comes right there that's just easy, kind of low-hanging fruit idea. And they take the easy meal rather than chasing everything that's out there. And I think it's the same way in the market. Sometimes the best thing that you can do as a trader is to not take a trade. And if a market is setting up where things just aren't there for you, don't feel like you have to take trades or force things just because, well, we've been taught I've got to do something. I'm in front of my screen. I've got to trade. The best thing you can do is make the right decision at the time. And sometimes the most successful day in the world can be a day you don't take a trade, because that shows you were not focused on trying to make money. You were focused on making the right decision. You were focused on process. And if you follow that idea of focusing on your process, focusing on making the right decision, that in that case, it's kind of one of those weird laws. When you focus on process, the results take care of themselves. If you focus on results, you're probably not going to get the results that you desire. So with that said, I wanted to look at a market where there was a ton of opportunity, and it was pretty easy to see, and that's the gold market here. You can see, as opposed to the E-mini, where it was a little bit back and forth, digesting the FOMC news yesterday, waiting on the employment report tomorrow morning. There just wasn't a lot to work with in the S&P, whereas in the gold, let's have a look at what we had to see. So, we had a big run up yesterday, and then we gapped down from the close of yesterday, and we opened in this area here. And so whenever you have any kind of a gap, if you want to look at it that way, we want to ask ourselves, do we think it's going to continue in that direction, or are we going to try to fill that gap? And a lot of times it's going to try to fill that gap, but you want to wait and see if you have some evidence. So the first structure we have to work with was this level 2 or strong buying aggression bar. And if that low can hold and we can get some follow through, then our expectation would be that we're going to go and test toward yesterday's close. That happened. We got a level 3 bar, a lot of buying aggression. The next bar decelerated, and we couldn't get a full bar above the high of this level 3 bar. And then we talk about kind of our expectations, or what, in quotes, what should happen. And what should happen is the low of this level 3 bar should act as some support. This green zone here should act as a support zone as well. And you can see the market bounced a little bit, but not much. And you can see pretty soon thereafter the market was trading below this level 3 bar, below this high velocity move. Okay, let me make this a little more clear. But in other words, we try to ask ourselves, this is something we talk about all the time, what's the market trying to do, and is it doing a good job of that? Well, you can see the market was trying to go fill in that gap from the close, and it was, buyers were stepping in. They were trying to take over the market. They couldn't take out the high. They weren't doing a good job, and you can see the market decelerated. And then we took out the low of that bar that, quote, should have acted as support, and it didn't, okay, and the low of this high velocity move. Then you can see the market tests up to this, sells off, and then right in this area, right in here, you can see order flows telling us that aggressive selling starting to come into the market. Then we break low or make a new low in the day on this level 2 selling aggression bar. And again, this level 2 bar should act as resistance up here. That happens to correspond with a resistance zone. That happens to correspond with a dark red filter. That happens to correspond with a level 3 bar on the high of the day that we could have no follow through and was rejected, which we know we talk about as one of our kind of our prime trades, a reversal type of a trade. So you've got a lot of evidence in this area right here for getting short. Buyers made an attempt, they were rejected. Sellers are starting to make a push forward. They are getting accepted. Things are turning over into the red high of that bar that sold off red. Things are really starting to come together, and you can see the market just sells off here. We have a high velocity move and a level 3 extreme selling aggression. Another one here, level 3 selling aggression, high velocity move. And you can see this is just a pure wave of selling. And it's not until this bar right here where we start to see price auction low enough to attract some, quote, bargain hunters, some buying aggression. You can see that this level 2 buying aggression bar comes in. We get follow through. Another level 3 bar, another level 2 bar. And again, that's not telling us that buyers have taken over this market necessarily, but what it is telling us is that this pure wave of selling is at least over. So if you did get in the market there, you'd want to think about getting out of the market, okay? Because it's showing us that at least we're into a two-sided activity. Now, on a bigger picture level, the next major selling structure we'd want to watch is the high of this high velocity move right here, as well as the high of this level 3 selling aggression bar. As long as that can be maintained, this strong wave, this last strong wave of selling, as long as that's maintained, you can see the market tests up in here and decelerated a few times. As long as that can be maintained, we would expect that sellers are still basically in control of this market. And you can see then we have a level 3 bar going and testing the low, another one making a new low, and then you can see the market tested, the filter's back to strong red, the market tests to a red zone, has a bit of a sell-off, and then here's the high of this latest wave right in here. You can see that it tested in there. So, this is a situation in the gold as opposed to the E-mini today, where the gold, where there was a lot of low-hanging fruit, there was a lot of, I'm not going to say easy, it's never easy in real time, but a lot of really exquisite situations where a lot of pieces of evidence were all coming together at the same place, okay? And when that sort of thing happens, you have an edge. Does it mean every trade's going to work out perfectly? Of course not, but you have an edge, okay? So this was a pretty clear and easy market to read today. Therefore, you want to strike while the iron's hot, so to speak. So I guess the key message, I wanted to point this market out, just show you, what is the evidence showing us? How can we make sense of that evidence? How can that give us an edge? And certainly there were some good opportunities here. But even more than that, we want to really, at least in my opinion, think about the idea of, staying away or sitting on your hands when things are not lining up or when there's conflicting evidence, and not feeling this need to overtrade or just be active in the market because you're there, but instead have the patience, have the discipline to wait for opportunity to really expose itself. So hopefully you found that helpful. Even if you don't trade gold, that lesson hopefully is helpful on any market, any type of trading, and hopefully you found that helpful. If you have other questions, by all means let us know, and we'll talk to you soon. Thanks.